Welcome to AK Shah's Foreign Exchange Made Easy class. Today is 25th session. Last day I have solved problems of call and put option. Today it will be continued. Before starting, I have to rectify one data in the last class. That is, you see here K is written as 4.576, it will be 75. The value 4.576 is the value of the put option. So other remaining same. Come to the today's problem. Last day I have solved this problem. Ascertain the value of option expiring 1 year later for the following securities. ABC quoted as rupees 120. At the end of 3 months, stock price will be either 150 or 100 or 150, and exercise price is rupees 120. And in the MNC Limited, the same. The exercise price is 350, stock price is 380, and it is expected to vary 250 to 450, and 12% rate of interest. Now, it is the call option value. Now I change this, that is, it is converted to put option. The exercise price is 120 for put option. Other data are remaining same. Now I solve the problem. Ascertain the value of option for the following securities taking strike price for put option. ABC Limited is quoted rupees 110. At the end of 3 months, the stock price will be either rupees 100 or rupees 150. Exercise price is 120. For MNC Limited, the strike price is rupees 350 and stock price is rupees 250 and rupees 450. The presently share is trading rupees 380. Now come ABC Limited. The strike price is 120 and future price is expected to vary from rupees 100 to rupees 150. Now, for rupees 100, the trader will exercise his right, that is ITM for put option, and value of the option will be 120 minus 100, that is equal to 20. But for 150, he will not exercise his right, that is, it is OTM, and the value of the option will be nil. Now, value of the delta option. Change in value in option divided by change in future spot price is equal to 0 minus 20 divided by 150 minus 100. That is minus 20 by 50 is equal to minus 0.40. You see, for put option, the delta value is minus 1 to 0. And for call option, it is 0 to positive 1. Here it is minus 0.40. Now, the amount to be invested in risk-free interest rate. Discounted value of higher price of stock. That is 150. In the call option, it is lower value, 100. Now, present value of 150 is 150 divided by e to the power RT, and this will come rupees 145.56. Value of the put option is equal to option delta multiplied with current stock price minus amount to be invested in risk-free interest, that is equal to minus 0.40 into 110 minus 145.56. Both are negative. So after multiplication, it will be positive and the value will be 14.223. In the previous problem, put option value is 14.23. Now, we have to find out the value of the call option. You put the value C minus P is equal to S minus K by e to the power 0.12 into 0.25 R into T. That is equal to spot price is 110 minus 120 by 1.0305. that is equal to 110 minus 116.45 is equal to minus 6.45. Now C minus P is equal to this. So C is equal to P minus 6.45, that is equal to 14.22 minus 6.45 is equal to 7.77. That is same and the previous problem that is taken call option. For MNC Limited, the strike price is 350 and future price is expected to vary from 250 to 450. For 250, the trader will exercise his right because it is ITM and the value of the option will be 350 minus 250 is equal to 100. And for rupees 450, he will not exercise his right because it is OTM and the value of the option will be nil. Value of the delta option, change in value in option divided by change in spot price, that is equal to 0 minus 100 divided by 450 minus 250 is equal to minus 0.50. The amount to be invested in risk-free interest rate discounted value of higher price of stock of rupees 450. Now present value will be 450 by e to the power RT, that is equal to 450 divided by e to the power 0.12 into 0.25 is equal to rupees 436.68. Value of the put option is equal to option delta into current stock price minus amount to be invested in risk-free interest, that is equal to minus 0.5 into 380 minus 436.68. Both are negative, so after multiplication it will be positive and the value will be rupees 28.34. And putting the value, you will find the value of the call, that is C minus P is equal to S minus K by e to the power RT is equal to 380 the spot price minus 350 by 1.0305 is equal to 40.36. Now C is equal to P plus 40.36, that is equal to 68.70. The problem can be solved by applying the probability when it is mentioned risk neutral method in the question. So here you will draw the diagram first. Spot price is 110 and upper limit value is 150 and lower limit value is 100. So U is equal to 150 by 110 is equal to 1.36 and D is equal to 100 by 110 is equal to 0.91 and RT it will be 0.03. So e to the power 0.03 is equal to 1.0305. Probability for upper limit is equal to R minus D divided by U minus D is equal to 1.0305 minus 0.91 divided by 1.36 minus 0.91 is equal to 0.267. It is the probability on the upper side. And probability of the lower side is equal to 1 minus 0.267 is equal to 0.733. It is written here on the lower side. Now the value of the call option is equal to 0.267 into 30. 0.267 is the probability into 30 is the value of the option plus 0 into 0.73 divided by 1.0305 is equal to 8.03 divided by 1.0305 is equal to 7.77. Now for ABC Limited, the put strike price is 120. Now you find out U, D and probability of the upper side is 0.267. That is equal to, you write here 0.267 for upper side and lower side is 0.733. Now the put value is equal to 0.267 into 0 plus 20 into 0.733 divided by 1.0305 is equal to 14.226. Next problem. Mr. X has rupees 3 lakh to invest in capital market. He considered stock of ABC Limited to be safe bet. ABC is currently traded at rupees 200 and expected to move in the range of rupees 190 to 250 within 6 months. Mr. X has decided to invest rupees 3 lakh to buy shares of ABC Limited and earn a maximum up to 25%, which is more than the risk-free interest rate. Mr. Y has rupees 3 lakhs to invest, but he considered Mr. X's proposition is to be risky. Having some knowledge on option, he intends to buy calls, invest at the risk-free interest rate of 12% for 6 months, and the strike price is rupees 220. What should be the price of the calls for Mr. Y's proposition to yield the same 6-month results later, that is minimum net wealth of rupees 3 lakhs? How many calls should Mr. Y buy? What would be the better of at the end of 6 months if actual spot price is 180, rupees 250, rupees 300. Now for X, there is no call option or put option. There is straightway investment of rupees 300 and he calculate his return after 6 months. That is, after 6 months, number of shares bought at the present 3 lakh investment divided by CMP, current market price is 200 is equal to 1,500. Now there are 3 possibilities: 180, 250 and 300. Investment is rupees 3 lakh, 3 lakh, 3 lakh in 3 cases. After 6 months, the return will be 180 into 1,500 is equal to 2,70,000. Here it will be 3,75,000. Here it will be 4,50,000. Gain or loss, first case 180, the loss is rupees 30,000. In the second case, the gain is 75,000, so 25% gain. And in the last case, rupees 1,50,000, gain is 50%. Now for Mr. Y, he exercised his right of call option. The strike price is rupees 220. The future price is expected to vary from rupees 190 to rupees 250. For 190, the trader will not exercise his right because it is OTM. But for rupees 250, he will exercise his right because it is ITM, not ATM, it is ITM. And the value of the option will be 250 minus 220 is equal to rupees 30. Value of the delta option, change in value of option divided by change in future spot price, that is equal to 30 minus 0 divided by 250 minus 190 is equal to 0.50. The amount to be invested in risk-free interest rate discounted value of lower price of stock of rupees 190 is equal to 190 divided by e to the power rt, that is equal to 190 divided by 1.0618 is equal to 178.94. Value of the call option, option delta multiplied with current stock price minus amount to be invested in risk-free interest, that is equal to 0.50 into 200 minus 178.50 is equal to rupees 10.53. The value of the put option, C minus P is equal to, you see, putting the value, you can get the result, that is value of the put option is equal to 17.72. Number of calls to be bought by Mr. Y, 1 by option value, option delta per share of ABC Limited, that is equal to 2 calls per share of ABC Limited. Cost of 2 calls is equal to 2 into rupees 10.53. It is already calculated here. Value of the call option is 10.53. So here 2 into 10.53 is equal to rupees 21.06. Now buying 1 share is equal to 178.94 into 1 is equal to 178.40. Cost of buying of 1 share is equal to 200. Number of shares, 3 lakh divided by 200 is equal to 1500. Total number of calls will be 1500 into 2 is equal to 3000. And total investment is equal to 178.94 into 1500. It will be 2,68,410. Now there are 3 cases, 180, 250 and 300. After 6 months, it is 180, 250 and 300. Strike price are same in 3 cases, that is 220, 220, 220. Value of the call nil because there is no intrinsic value. Here it will be 30, here it will be 80. 300 minus 280, 220. Number calls of 3000, 3000 and 3000. Value of the call after 6 months, 3000 into 30 is equal to 90,000. And 3000 into 80 is equal to 2,40,000. Maturity value of investment is equal to 2,68,410 into e to the power RT. That is equal to 2,85,051. Here it will be 2,85,051 and here it will be 2,85,051. So it will be added 2,85,051 plus here it will be nil. So the closing net worth is equal to 2,85,051. Here it will be 90,000 plus 2,85,051 is equal to 3,75,051. And here it will be 5,25,051. Now less investment, 3 lakh, 3 lakh, 3 lakh. Change is loss 14,949, profit 75,051 and here 2,25,051. Percentage 4.98%, here 25.02%, here 75.02%. Now in Mr. X, the percentage gain or loss is 10%, 25% and 50%. And comparison, here there is no comparison, it is indifferent, same in the both cases, and here better for Mr. Y. Now comes straddle. Straddle is relatively conservative strategy in comparison with strategy of strangle. Here the range where the security price hover is not wide but narrow, may be 1 point, representing the strike price of call option and put option, both are same. You see the diagram here. In short straddle or long straddle, you see that in short straddle it will be sell 1 ATM call and 1 ATM put, and the strike price in both cases are same. If you see this, you will take that it will be short straddle, and premium receivable is 200 because it is sell rupees 200 and here it is 150 for put option, and total premium received is 350. This is the maximum profit. You see the diagram. When the underlying price reaches this point, that is strike price, then the profit will be maximum and it will be 350. And when it comes down, the market goes down or up, it is bearish side and it is bullish side and it is bearish side. Now it is decrease from this point, then the profit will be decreased gradually up to point BEP where it is nil, and when it is crosses the loss started and that may be unlimited. Same case in the bullish side. The profit will be decreased up to the point of BEP, and if it crosses the BEP, the loss started and it will go to the unlimited. The loss is unlimited if the price moves in either side. There are two break-even points. One is upper break-even point and another is lower BEP. The higher and lower BEP is strike price plus minus total premium receivable. Here plus 3000 plus 350, it will be 3350. Here 3000 minus 350, it will be 2650. Now here short straddle, here the trader will earn maximum profit when the underlying price reaches the strike price, and the profit will be started to decline when the market moves in either side, that is bullish side or bearish side, up to the point of BEP where it becomes zero. He will suffer a losses if the market falls below this level in either side. Now in short straddle, a trader will sell one ATM call option and one ATM put option having the same strike price and for same maturity, say for 1 month. When the underlying price reaches the strike price, the profit will be maximum, which is the summation of two premiums. When the market breaks it either to bullish side or bearish side, the risk start and the return will decline continuously up to BEP, break-even point, where it comes to zero, and after that the trader will suffer losses which may be extended to unlimited. Here the ATM strike price call is 3000 and premium receivable is 200, and for put option the premium receivable is 150. Now come the solution of this. In short straddle, current market price short ATM call strike price is 3000 and premium received 200, and here for put option strike price is 3000 and premium received 150. You see up to 3000 from the lower side, the short ATM call trader will receive premium. When it crosses 3000, the loss will profit will decline gradually, and then up to BEP it will be zero, and after that starts losses. And here for ATM put option, he will gain the premium up to the point of 3000 from the upper side to 3000. When the market moves downwards, then the profit will decrease gradually and then up to the BEP point, and thereafter the trader will suffer losses and it will be maybe extended to unlimited. Now 3000 is the highest profit. When the market price reaches the strike price 3000, that is 200 plus 150 is equal to 350 is the highest profit. And the 2650, Here the BEP point, you see 200 is the ATM short call received the 200, and here minus 200, that is minus 350 plus 150 is equal to resultant profit will be 0. And when it goes down, the loss will start it and it will gradually increase. And when the market price goes up, that is after 3000, that is become 3100, the profit will decline. 3200, the profit will decline, and up to the BEP. Then start the losses and it will be extended to unlimited. That is, you see the diagram, the loss will go up to unlimited if it moves either bullish side or bearish side. Next come long straddle. Long straddle is reverse the diagram. Here the trader will buy one ATM call, strike price is 3000 and premium payable is 200, and the strike price for put option is 3000 and premium is 150, total premium paid 350. So when the market price reaches the strike price, then the trader will suffer the maximum loss, and this loss will be decreased when the market moves upward in the bearish side or on the bullish side, and this loss comes down to 0 at BEP point. And if it crosses the BEP, the profit starts and it may go up to infinity, unlimited. In long straddle, a trader will buy one ATM call and one ATM put with the same strike price for the same maturity. Here the trader will suffer maximum loss when the underlying price reaches the strike price. The maximum loss will be the summation of the two premiums. When the market breaks it either to bullish side or bearish side, the recovery of losses will be started continuously up to the point of BEP where it comes to 0. After that, the trader will earn profit which may be unlimited. The long straddle strategy is used when the trader believes that the underlying price will experience a significant volatility but is uncertain about the direction of the movement. But in the short straddle, the trader will believes that the market is certain, not uncertain, volatility is low, so he exercise the straddle. But here the long straddle strategy is when trader believes that underlying price experience a significant volatility but is uncertain about the direction of the movement. So either bearish side or bullish side, he will earn profit, and that may extend up to unlimited. If the asset price moves significantly in either direction, the trader can profit from the option which reaches in the money ITM position either in the bearish side or on the bullish side, while other option expires worthless, because one option he will earn and other option he will not earn, that is goes expires worthless. The long straddle has two BEP, that is strike price plus minus total premium paid. If the comparison the profit and loss in either short and long straddle, you will come later, is higher than the short or long straddle. In the case of straddle, Profit or loss is higher than the strangle. The cost of straddle is also higher than that of strangle. In both cases, there are two break-even points. One is higher BP and other is lower BP. It will come when I discuss the long strangle and short strangle. Now here, buy one ATM, strike price is 3000 and premium payable is 200, and for put premium is 150. Here the table, up to the point 3000, the trader will lose the premium paid 200, that is fixed, and up to the point 3000 for ATM put, the trader will lose up to the premium paid 150. When it crosses upward or downward, the loss will be decrease and it will be goes to the profit session. That is, profit may be extended to infinity. If you see, the break-even point is 2650. The break-even point is 00. Up to this point, the loss will comes to 0, and when it crosses, the profit start. It is on the bearish side. And if it come here, the BP point is 3350. The BP point, after it crosses, the profit will start and extend it to the unlimited. Today, I stop the class here. Next day, I will discuss the long strangle and short strangle and another problem of short straddle. Thank you.